The only reason that any of us put up with market downturns is because we believe that it's profitable to own businesses over the long run. And we think that because it is. Now, this is a short one today, but it's a gooder. Okay, I am straight up stealing other people's stuff here today and wrapping it up into a nice little package for you. If you want to look into any of it more, I've got links below in the description and I encourage you to check it out. But make sure that you stick around to the end of the video today for a particularly eye-popping clip. Now, before we dive into things, I do just want to stress that I am not recommending or referring to any particular investment here today. I don't sell any investments at all anymore. In fact, in our firm, we partner with top shelf portfolio managers to handle all of the individual investment decisions for our clients. And that's all they do. And they are good at it. What I focus my time on these days is planning, advice, and helping my clients understand how things work. Because once you understand how things work, once there's clarity, once things become intuitive to you, it's a game changer. You can make way better decisions, and you'll stick with those decisions because you understand the logic behind why you decided to do them in the first place. Anyway, let's get to it. The first two bits I'm stealing are from an article by Ben Carlson, a portfolio manager down in the States. This whole article is gold, but I want to highlight two charts. The first one is pretty self-explanatory. This is a graph of total returns of large US companies from 1824 to now. So no small startups in here, just large, stable, boring, brilliant, profitable businesses. Title says it all. In the long run, stock prices go up. Yep, they do. And that's why we put up with all of the garbage in the short run. And some of that garbage can be particularly nasty. The Great Depression, World War II, financial crisis of '08, COVID crash, etc. However, while they were very real in the moment, and definitely they are blips on a graph now. We moved on. Humans woke up every morning and figured out ways through or around their problems. And that is just literally how it works. And it plays itself out in the businesses that are around us because they are just made up of humans. Next chart. This one shows the best and worst returns over different periods in the S&P 500 from 1926 to 2022. And just in case you aren't familiar with it, the S&P 500 is just an index or a grouping of 500 of the biggest and best companies in the US. Anyway, look how violent it can be over the short term, both on the downside and the upside. The worst one-year performance in these 96 years, which includes the Great Depression, by the way, is negative 43.8%. That is a bad year. Really bad. But look at the best year, 52.6%. Stunning. And these are the kinds of returns that tend to follow right after the worst ones. Now, I don't want to waste your time and go through each one of these periods, but what you'll notice is that time smooths out the chaos. Well, let's just jump out a bit here to 15 years. The very worst 15-year period on record is negative 0.2%. That's the worst. The best 15-year period is 18.8%. The worst 20-year period on record is 2.4%. The best is 17.7%. The worst 30-year period is 8%, and the best is 13.6%. Now, let me just say that one more time. The worst 30-year period is 8% return. That was the worst. So if you plan to be retired for anywhere even near 30 years, or if you plan to pass money down to the next generation, you should at least consider the idea of being a business owner. Last chart. This gem is from Vanguard. The green line is showing the value of a $10,000 investment in the US stock market in January 1992. Each orange line you'll see is showing what would happen to your money if you jumped out at the bottom of a particularly nasty downturn and plugged your money into US Treasury bills, which is basically saying, here's what it looked like for those who jumped out when things were at their worst and fled to what they thought was safety. Now, I'm just going to keep my mouth shut and let the numbers do all the talking here. Is this all there is to say on the topic? No, obviously not. So please don't take it as such. And I'm also not recommending that you take all of your money and put it in the stock market. Not at all. I just did a video about a month ago on the importance of having significant cash reserves throughout retirement. And part of the reason is so if you do have a lot of money invested in the markets and you go through a particularly nasty downturn, then you've got that money as backup. But regardless of anything I ever say, you need to know your own particular situation or pay someone else to do that for you so that you can make wise decisions for you. The point I'm really trying to hammer home here is that economic downturns are part of the cycle, but they're temporary. And those of us who choose to be business owners get paid to put up with that volatility, and it can be super profitable. Otherwise, none of us would do it. But of course, there's more to say about all of this. And so if you're looking for more of a deep dive on my investing philosophy in general, then you're going to want to check that out here. Just kidding, here.